Hello traders, Gary Wagner here, just about 10:40 in Honolulu, 3:40 in New York. It is Wednesday, March the 9th, 2016, and this is the Daily Report for Gold and Silver. We do have downside pressure in the precious metals markets. Gold trading off, currently trading at about $12.50, $12.49, puts it off about $11 when we consider spot. Of course, when we look at straight COMEX, puts it off about $12 on the day at $12.50.80. Low on the day so far has been $12.43. The high has been $12.65. And as I said, our current print puts it at around $12.49, $12.50. Of course, we did have a long position in gold. If you recall from yesterday's show, we went ahead and we tightened our stop to just below $12.55. So call it $12.54, $12.53.50. We got out with a nice profit considering we got in at $12.17 and out at $12.54. We'll talk about the trade in detail as we look at some charts, all on today's video report. So traders, as you can see, we have pulled up a 720-minute chart. It's a chart that we looked at yesterday. It's a chart we've been using over the last couple of weeks, really to look at our short-term Elliott wave count, wave 1, wave 2, this extended wave 3, a consolidation in terms of our wave 4, and what I believe to be our wave 5. And it absolutely appears, as we talked about yesterday, as though there's some real resistance in the market. Of course, we got long this market, and we went long at roughly, about $12.17. So right in this area here, we were able to ride this up and consistently trail our stops up till where we did yesterday when we trailed our stops just below 55. So roughly in this area, you can see that this low has taken us almost to about $12.40, $12.43 on the low. And so the question is, does this particular move have any real devastating consequences in terms of long-term chart damage, or are we possibly just looking at a correction which can be not only warranted, but expected? And to that end, I believe that what we are witnessing is a correction which can absolutely be, not only is it warranted, but is to be expected. Now, this red line here is simply a match in terms of the space or the distance moved of this wave 1. Because as we talked about yesterday, wave 1 is our benchmark for wave 2, for wave 3, as well as wave 5. The only wave that you're using any other wave as a benchmark, of course, is 4, and that benchmark is off of 3. Now, if we move this line up, and it is a scalable line, to roughly where we're looking at the conclusion of this wave 4, it is a compression triangle, but if you look at this one area, this is a 61% retracement, and it's a retracement of this move here from these tops here. The one thing that we can say is, yes, we did get some real resistance at 1280. And in terms of a fifth wave, this would be, in essence, a truncated fifth wave, in my opinion. And the reason I believe it's a truncated wave, that's one way to look at it, is because if we look at really the beginning of where 4 should start, you could fix it here, you could really fix it here. It should have come up to, as I talked about yesterday, about 1292. So we certainly are short of that, but we have certainly now seen this market move up to 1280 and then give back a substantial amount, considering 1200 maximum support in the marketplace. 1280 and then a move down to 1240 is about a 50% retracement of that move. There is another way to look at it, and the other way to look at it would simply be that we are still within this wave 5, and of course, as I said, that's a sub count, but we could have our fifth wave and that be composed of a 3 count, 1, 2, and then our final 3 would take us up to this 1290. In fact, let's put this in a little bit better so you get a better idea of what I mean. But from here to here, and then our final whip up, a 3 count, and then that would conclude our wave 5 like that. So I'm not convinced that we won't see more downside pressure, but we do have really eloquent models to explain whether or not what we're seeing is going to be a short-term dip in the market or a more protracted real correction. Because if in fact we've reached our 5th wave, the conclusion of our 5th wave, so in essence what we're looking at is 1, 2, 3, 4, 5, then we should go into some sort of an A, B, C correction, and then that's going to be based upon the entire high to the entire low in terms of what we're going to look at and plotting different various retracement points that we could see this market go to. The bottom line is we bought at 17, we sold at 54, we made a tremendous profit. I believe this is our 5th trade of the year. This is the 2nd most profitable. Of course, the most profitable trade was catching this 3rd wave. And when we caught this 3rd wave, we caught, $120, $130? Not really sure, but we caught well over $112, on that trade. So that, of course, was our best trade of this year. But this, nonetheless, is a profitable trade. And I leave you with the words of Herbert Hoyle. And he was one of the most profitable stock traders in the 1950s. And in fact, he was trading when a lot of people were losing money. He was interviewed once, and the interviewer asked him, quite frankly, they said, "Mr. Hoyle, why is it that you consistently make money in the market when the majority of traders lose money?" His answer was simple. It was one sentence, and it was concise. He simply looked at the interviewer and said, "The reason I make money is I always sell too soon." This has been Gary Wagner, wishing you, as always, good trading. Talk to you tomorrow on Thursday for another daily update and review.